welcome to this week's episode of Coinscrum Markets. I'm Teana Baker-Taylor. Coming up, ByteTree's James Bennett returns to look at Onchain data in this week's Onchain reaction. R3 CTO Richard Brown joins me to discuss 5 years of enterprise DLT. And Trustology's Alex Batlin speaks to Hugh Karp from Nexus Mutual and Dan Roberts from Nayms about the growth of the smart contract insurance market. But first, let's take a look at this week's blockchain industry news. DBS, the Singapore-based financial services group, may be about to enter the crypto asset space, according to a page on their website, which has since been removed. Before it was taken down, it was noted that the company will offer access to an integrated ecosystem of solutions to tap into the vast potential of private markets and digital currencies. When asked for comment, a spokesperson confirmed that DBS's plans for a digital asset exchange are still a work in progress and have not received regulatory approval. The hash rate on the Bitcoin network was back in the news this week when it made a new all-time high before taking a sudden plunge. The recent strong rise in hash rate is being attributed to the growth in debt financing to help miners expand operations over the past year. However, just as it seemed nothing was going to halt the rise, there was a sharp turnaround when Chinese miners suddenly wound down a considerable proportion of their operations at the end of the wet season that has seen them benefit from particularly low rates for purchasing hydroelectric power. Following a swath of positive news in recent months that's helped Bitcoin climb to its highs for the year, MasterCard's CEO Ajay Banga struck a more cautious tone this week when speaking at Fortune's Global Forum, saying Bitcoin's price volatility has made it bad fit for the financially excluded, something that many Bitcoin advocates have championed over the years. And finally, U.S. investment bank JP Morgan continues to soften its approach toward Bitcoin and other crypto assets. Following its decision to provide banking services to U.S. exchanges Coinbase and Gemini earlier this year, a research paper it published this week predicted a positive future for Bitcoin, stating that its continued adoption by millennials could see it challenge gold's traditional safe haven status and drive its price much higher. At the same time, it was revealed that the firm is engaging with a number of firms within the industry to find out how it can offer digital asset custody to its clients. That's the news for this week. Make sure you remember to subscribe to our channel. Next up, James Bennett returns for this week's Onchain reaction.
Hello and welcome back to Onchain Reaction. I'm your host James Bennett and I'm the CEO of ByteTree. ByteTree provide on-chain data for digital asset investors to help them navigate this ecosystem. So this week we're going to start off by looking at price volatility. A couple of weeks ago we spoke about the fact that price volatility was reaching a close to unprecedented level, around 20 to 22%, which for Bitcoin is extraordinarily low. We were calling for a break in either direction, with volatility having been squeezed down at the low end, and we've seen that this week with a break up towards $13,500 at the time of recording, Wednesday the 28th of October, around lunchtime. So with that sort of break to the upside, volatility has returned. We've jumped from around 22% up to close to 31%. And we expect this to continue as there's quite a lot of price action ongoing today. Okay, so now moving on to our first on-chain indicator. This is a simple one. We're looking at the total value of transactions settled on the Bitcoin network over the last 7 days. So a 7-day moving average of transaction value. And we can see those bars along the bottom there. And then that light blue line is the 7-day moving average of those bars. Transaction value has picked up sharply along with the increase in price volatility that we've seen, and as a response to increased price action. So transaction value has been pretty flat the last few months, but is peaking again as it did in August and in May, both times of heightened volatility and price action. Okay, so often we like to comment here on the miners. So on this third slide, we're looking at the miners' revenue streams. So recall that the revenues for miners are made up of the new coins generated and the transaction fees. This week, we've seen fees surge to 24% of total miner revenues, which is the highest we've seen in the whole of 2020. That's essentially, that's around $12 million per day in fees. And it shows that really there is a lot of competition for block space at the moment, as there are simply more transactions than there is space for blocks. Now, why is that the case? Well, moving on to the next slide, we can see that miners are struggling with the new all-time highs that difficulty is currently at. So the blue line there shows you the average block time. The dotted line that's running horizontally across the screen is what the sort of base case should be. So a block comes every 10 minutes. When that blue line is above that base case of 10 minutes, it means that blocks are taking longer than 10 minutes to arrive. And just think about it, if there's less trains leaving the station but there's the same amount of people, then you're going to have a lot of crushing and squishing in order to get on those trains. If there was a payment mechanism, I expect people would be prepared to pay more in order to get that space. It's the same thing with the Bitcoin network. We're seeing fewer trains leaving, and in fact we're seeing a higher number of transactions as well. So you've got that real competition for space. The other thing that you can see on this chart here is that difficulty is at all-time high, as I just touched on, but that we are very much likely to see a big correction downwards in the next few days, which is the next difficulty retargeting. The two peaks that you see there before in April and around June of this year, both times that block times went above 10 minutes, so you see those peaks at the top. The reaction was that we saw a significant drop in difficulty, and you can see that on the stepped grey line along the bottom half of that chart. So expect a difficulty adjustment incoming as a result of this increased times between blocks. Okay, so on to the next chart here, we can see that miners have been heavily offloading the newly minted coins into this strong market bid. So we've seen price rise over the last 7 days by about 14%. From just shy of $12,000 to $13,500, and miners' response has been to sell their excess inventory. So contrary to popular beliefs or perhaps expectations, miners aren't just selling their Bitcoin in order to cover their operating costs. We actually see miners as very strategic market participants who sell when the market bid is strong, and when the market bid is weak, they actually tend to hold back on selling. They know that the market can't hold it and that it will likely just crash the price further. So we can see in reaction to the strongest price action that we've seen all year, miners have reached a new high for the year in the rate that they are sending or spending their newly minted coins. Okay, so now moving away from miners and onto one of our favorite valuation metrics, which is the NVT. That's the network value to transaction ratio. If you want more information on this, you can find it in the ByteTree glossary, and there's various blog articles you can read more about it there. But essentially what it is a price to sales ratio for the Bitcoin network. So we look at the amount of transaction activity that's going across the network relative to the total value or market capitalization of the network. Bitcoin doesn't have a cash flow or traditional earnings, but it does have a sort of value transfer mechanism, and it does of course have a market cap. So the NVT is what we use to show relative valuation. We don't have an absolute number of what should NVT be, in the same way that price to earnings can escalate significantly depending on the company and the sort of bullish or bearish sentiment that's currently in the market. But, we've typically seen that an NVT measured over a 5-week period that's above 12 is historically very high and overvalued, and Bitcoin doesn't like to spend much time at that level. Similarly, we use a derivation of the NVT in a fair value metric that we've computed at ByteTree. And the NVT that we use there is currently giving us a fair value of Bitcoin of around $8,400, which puts us at about a 61% premium. Now that does sound very high, and again, Bitcoin, although we're on a positive move right now, we are slightly wary that we're getting a bit ahead of the current sort of fundamental demand, and we would expect to see some retracement in the next couple of days. With that said, overall sentiment very positive in the market. There's a lot of growth. We're seeing new highs in number of addresses using the market, and we're also seeing transaction value across the board pick up. A lot of new participants entering into the market too. So, we're very excited about the coming weeks. And with that, I'll hand back to the studio.
R3 was the first enterprise consortium to form back in 2015, when its founders recognized the opportunities that blockchain or distributed ledger tech could offer to the banking sector and beyond. 5 years later, their CTO, Richard Brown, joined me to discuss the lessons learned, progress made, and the future for enterprise DLT. It's a pleasure to have Richard Brown joining us today, CTO of R3. Richard, thanks so much for coming on the show.
Thanks so much for having me. Thanks, Teana.
No, it's fantastic. So we are going to cover maybe the last 5 years in enterprise blockchain and what's been happening at Corda. Before we get into the design of the protocol itself and what R3 has been up to in those 5 years, how has the offering or the tech changed, and how has that impacted your roadmap over the last 5 years? I'm sure there's been some key lessons learned that have contributed to iterations along the way.
Yeah, so people don't always realize this, but R3 was not founded as a software firm. I wasn't hired to build a product. The original vision, if you like, the original contract for that first year was to run this exploratory collaborative working group. It was only the results of that, and they appeared quite early on in that year, but they began to evolve over time. It was only the results of that made us realize that the world needed a platform that was built from the ground up to solve the problems we were discovering. Because we were discovering things like the following, that yes, if you could ensure that all the parties to a complicated syndicated loan, say, were in sync, all the different lenders received information about the underlying, the underlying loan at the right time and in the right place. If you could solve that problem and remove all these inconsistencies and errors between firms, it could be extraordinarily valuable. If you could enable, tokens representing claims against a bank to move around between that bank's customers without the bank having to sign off on every single transaction, that could be insanely useful. So we kind of validated the underlying belief that these technological principles could solve problems in finance. But what we also discovered, which again is obvious, but you have to go through the process, is that some of the things that, take Bitcoin, for example, some of the things that are just like non-negotiable and have to work this way in Bitcoin are not appropriate for a banking scenario. For example, for good engineering reasons, the entire Bitcoin blockchain needs to be replicated to all nodes. Everybody has to be able to validate everything. There's a good reason for that, and it works that way as a result. We kind of have the opposite problem in finance, where the only people who should see a deal or know that it exists and then be in sync about it are the parties to that deal. It's not relevant to anybody else.
What were the most critical features that you realized at the beginning would need to differ from Bitcoin's design? And what were the most pertinent components of Bitcoin that were both unique and useful in the context of an enterprise use case?
Great question. So what is Corda? So Corda is a platform for writing applications. So one way to think about it is a bit like Ethereum. Ethereum by itself does nothing, but Ethereum allows you to write smart contracts and then allows you to deploy them. And Corda is similar in that way, in that Corda allows software firms, banks, insurance companies, anybody who wants to write applications where the purpose of those applications is to be deployed to and amongst all the participants in a market or who are executing a certain type of transaction. So rather than writing an application that runs inside one firm, as has been traditional in IT, you write an application that automates and improves the processes of an entire market, reinsurance, syndicated lending, or whatever it is. So it's so the idea is you can write an application, you write it once, and then all the participants deploy it. And the key problem that Corda is solving is that for each piece of data being managed by this application, a loan or an insurance policy or anything like that, the Corda makes sure that it is received by all the people who should have a copy, and the copy they receive is identical. So everybody knows, sort of the catchphrase we use, that when I'm looking at my Corda node, I know for sure that what I see is what you see. We both know that we see the same thing, but critically and differently to some of the true cryptocurrencies is you only see the things you're supposed to. You don't see transactions you're not supposed to, and for the reasons I've just described. So what do you need to make that work? Well, you need the ability to write the applications. Well, it's not sexy, but most application developers in large organizations, they don't know things like Solidity or Bitcoin script. They know languages like Java or Kotlin. So we make it possible to write the applications in those languages on Corda. What we also discovered, and this was not part of my original vision, this was something that Mike Hearn, intuited the need for as we went, was that it's not sufficient to simply move around signed transactions to say, yes, I agree that this loan is now this value and it's between you and me. It's not enough to create the transaction and sign it and then link it to the previous version as a chain of transactions with unspent outputs and all those things that you see in, say, a Bitcoin style architecture. You need all those things, and Corda is heavily influenced by the Bitcoin UTXO model. But you also need some way of moving them around, because before you and I can sign a transaction that says you owe me $1 million, well, we have to negotiate it. What's the interest rate? Who else needs to be involved? We have to agree, and we have to have a way of describing how this data moves around the network, who's responsible for doing which step next. So almost by accident, we realized that we also had to build a decentralized workflow engine. We needed a way to describe what each participant in the network's role was. Who's the buyer, who's the seller, who's the borrower, who's the lender. We needed a way to describe that orchestration of behavior in a way that doesn't have a central conductor, a central controller. So we discovered the need for additional features like that.
So how have clients' interests and requirements evolved over this time? You started out trying to address, the banking use case and seemed to be the most obvious sector for delivering results. But you've also played in the areas of healthcare and trade finance and shipping and insurance. And are these use cases now becoming easier sectors to attack and solve problems with Corda?
We designed Corda thinking its target market wasn't even just banks, because we thought it was the back offices of investment banks, because they were the original R3 members. It was the big US dealer banks were the original backers of R3. So I thought I was building quite a narrowly focused platform for solving problems in the back offices of the big investment banks. But I guess you could say we got lucky. We ended up with, and this is partly because of the team. I hope some of it was my insight, a huge dollop of luck and a huge dollop of insight from people like Mike Hearn. But we ended up with a design that, whilst it was derived from all these requirements in financial services, turned out serendipitously to be far more broadly applicable. And I was slow to realize that, because I was fixated on these financial services use cases. And it was only when one of our senior executives in the US, Ryan Rugg, kept badgering me that I realized, because she kept saying to me, Richard, you don't realize you've built a platform that is perfect for insurance. And I said, well, that's interesting, but that's not what I'm focused on. And it was only when we discovered that completely independently of us, that various insurance consortia had independently discovered Corda and had built on the open source version, that I began to pay attention. So it's kind of great. Just, I say serendipity, but that doesn't happen very often in your career when you think you've solved a narrow problem, and then the market tells you you've actually solved a much broader problem. And then, as you say, trade finance has been great. Contour, Marco Polo, these big trade networks are using it. Healthcare, oil and gas, even gold trading. Tradewind markets up in North America were amongst the very first adopters of Corda, and they're going great guns for the tokenization of gold.
So, how many projects and use cases do you think you guys have now out in the wild doing their thing?
Oh heavens, I don't know, hundreds, literally hundreds, all at different levels of maturity. So we may come on to talk about some of the large scale production projects. There are lots of small scale production projects, and then a whole bunch of others in the pipeline. And I guess it's also part of again, I keep using the word serendipity, but it is the serendipity of the platform being open source. It's the core Corda protocol, the code base that defines the protocol is open source. Go to GitHub/Corda, there it is. So there's a whole bunch of people using it who we don't hear from until they've gone live, and then they say, you know what, we'd like to pay for support on this, or we'd like to have better performance, and then we discover that there's people using it that we can then potentially sell the commercial version to if it fits their needs. So for a while we had it's something that we need to refresh it, but we had a website called our marketplace where we showcased all the projects we were aware of, and that was when I last looked at that, it was a year or so ago, and there were hundreds, and it's only increased since then. So it's been quite a ride.
Well, and I think when people think about enterprise blockchain, they don't necessarily, correlate network effect with, enterprise, right? They kind of seem to be disconnected in some way. But what I'm hearing from you is that, the network effect has indeed triggered expansion and wider adoption across multiple different sectors from Corda.
Just on that, just very quickly, I agree. I won't claim it's been easy, and I did have this belief at first that eventually there will be a single global Corda network, like the single global Bitcoin or Ethereum network. It hasn't played out like that yet. There is a Corda network. There are many different projects on it, but there are also a large number of standalone networks. And then the question then is, well, is there a network effect between them? Technologically, not yet, although you can integrate and interoperate between them. But there's this sort of meta network effect, which is people want to build on platforms that they know will be around for the long term. So even if they don't plan to integrate with each other, people are making long-term bets. So they want to see that the firm is hopefully well run, well capitalized, but also that it's technologically on the right path, so that they don't have to do a sort of handbrake turn in a year and re-platform.
So let's talk about one of the more interesting projects. Spunta Banca DLT platform. Sounds like you've got about 100 banks and 200 million transactions. It was built on Corda. Tell us a little bit about that project.
Yeah, this one's mad because it's you build these things, and it's always in the abstract. You build your platform and you hope people will use it, and then I didn't wake up one day because we've been heavily involved, and there's been it's been a hard process. But it's as if you wake up one day and you discover, oh my God, the Italian banking system now depends on Corda. Yeah. So the idea here is, you think about all the hundreds of different banks and all their branches in Italy. There's a process, a fairly manual process until recently they were running to reconcile between them. So it doesn't sound that exciting, but it's fundamental to the integrity of a country's banking system. Checking that if one bank is holding a deposit with the other one, do they agree about the amount? Do they agree that a payment from one to the other has been correctly recorded on each side? So it's an important process. In Italy, there are some interesting contextual factors that make it ripe for, excuse me, that make it ripe for this kind of project. There is a large network provider called SEA. They are a huge provider of infrastructure, big across continental Europe, but they've already linked securely all the banks in Italy. There is the Italian Banking Association and their labs, Abi Labs, who heavily visionary and weren't just interested in doing POCs, but saw they'd done the analysis. They realized that this specific reconciliation process was, time-consuming, manual, prone to error, and was absolutely perfect for the, I know that what I see is what you see promise of Corda. And then they selected Corda for this. And then full credit to them, they brought the industry with them, they brought the market with them. They went through many stages of development on this. It was a long process, and you've got to remember that we were building Corda at the same time, so they were very tolerant of us as as Corda matured. We fixed problems, we evolved it to meet their needs. So it was so great to see it go live properly at the start of this year, and then really ramp up in the last few weeks. So it's but it's no small pressure, because here I am as the as the CTO of R3, knowing that the integrity of the Italian banking system depends on our software. So it's this like formidable responsibility as well as a great feeling.
What's happening in the Corda space around fiat-backed tokens, CBDCs, collateral management systems? What kind of work are you guys doing around settlement interoperability?
Yep. So this is where I'm going to show my. I'm actually not fully up to speed on some of this. So there's we've done a huge amount of, and I guess like every firm, we've done a huge amount of proofs of concept over the last few years. Proving what it would, or showing what would be necessary for a central bank to issue a claim on the sovereign, whether it was early work in Canada, Japan, Singapore. There's another one we're involved in, but I don't know if it's public, so I won't say it, and then I can text you afterwards, and you can add it over the top. So there's a whole bunch of work we're doing with CBDC, but there's the other side of it, which is exactly as you say, which is, if you look at our customers on using Corda, they need the ability to settle now, and it doesn't follow that the only way you can settle is with an on-ledger token. Clearly, that makes it easier in some cases, but the firms using Corda, the firms using all these different applications that are being deployed, they already have bank accounts, they already have integrations to their existing banks. So we spent a lot of time, and the first version of this was something we called Corda Settler. The insight was, it's not necessary to settle across the same ledger as where the obligations live, provided when you as the payer have made the payment, across whichever rails, just through the domestic scheme, whatever you want, provided that once you've made it, you can prove you've done it irrevocably and irrefutably to the recipient. Because the problem really with payments, or one of the big problems, is being able to reach consensus that it happened. So have I sent it to the right place? Did you receive it? That's where the mess happens. So if we can use the flow framework in Corda to negotiate where I'll send the payment and what you as the recipient will accept as irrefutable proof, now the onus is on me as the payer. I make the payment, I get the proof. Maybe it's a signature from the recipient bank. Maybe it's a signature from Swift, with whom we've also been doing work. I can now take that signature, attach it to the transaction on Corda, and use that to move the smart contract to the completed state. And you as the recipient, you don't get the right to mess around and say it hasn't arrived, because I've provided the proof. So we stay in consensus, and all that mess and pain of payments goes away. So net, we're trying to do both. We're doing a lot of work on bringing central bank or commercial bank backed tokens onto the platform, and there's quite a few advanced projects there. But also accepting and acknowledging that in many cases, simply being able to settle across existing rails is perfectly fine for many. And the problem to be solved there is, how do you prove you've done it?
Okay, so what's next, Richard? What's on your roadmap for the next 12 to 24 months? What are you most excited to see get developed?
So a few things. So I guess there's Corda, there's customers, and there's broadening the offering. So customers first. There's we've just heard all this noise about and news about Spunter really hitting prime time. There's a whole bunch of other projects behind them that are in early go live that will really hit scale next year. So I'm really looking forward to seeing sort of the real scale out of the trade networks like Marco Polo and Contour and things like that. There's a whole bunch of work being done with digital assets that I've not even talked about, such as the work being done by the Swiss Digital Exchange and projects like that. So there's some MasterCard have been very open about what they're doing with Corda. So there's some big firms doing some projects that should all really hit the mainstream later this year or into 2021. Corda itself, and we're deep in planning for what we're calling Corda 5. So everything we've learned from all this work over the last 5 years, we're using that to figure out where we should evolve the platform. How do we make it, and it doesn't sound that exciting, but how do we make it easier to deploy? How do we make it easier to upgrade? How do we make it easier to write apps? All the hygiene stuff that takes POCs and so it takes projects and makes them repeatable and affordably. And then the final thing, and this is a lot of my focus right now, is actually broadening the offering. Because if we go back all the way to the beginning, what were we talking about? We're talking about how do you get participants in a market? How can they collaborate and cooperate better around their data for some better outcome for them and their customers? And Corda and blockchain is all about, you and I have done a deal. How do we ensure we're in sync? But once you start building platforms and you roll stuff out like in Italy, where all these firms are talking to each other, it's not just about sharing data. Often there's some outcome you want where you can't share the data. And there's like a very simple example is, let's imagine all the manufacturers in a country, you have a particular widget, they're desperate to know what their market share is. But you can't share your sales data with your competitors. It's probably anti-competitive, and also it's commercially sensitive. But if each of you could share your sales data with some trusted party in the middle, they could add it together and then give you the total, and you could calculate your market share. But of course, that central party would then be really powerful, and that's the basis, I guess, of many market data firms. That's how they make their money. You generalize that, and you end up with business models like Bloomberg's and so forth. But given that we're already building out these networks that allow these firms to talk to each other and share data, the only missing piece is the ability to centralize that data, perform a calculation, and send it back without that central party seeing anything. And that's the essence of something called confidential computing, which, if you like, is a sister technology to blockchain. We've been working on this for several years because we need it for a particular privacy aspect of Corda, but we're now in beta, and it will GA at the start of next year, a product called Conclave, which is all about allowing you, and it kind of sounds counterintuitive, but it will allow firms to build applications where I can send data to you and I will know exactly what you will do with it. I'll be able to know that you'll do one thing, but you can do nothing else. So I could send my sales data to you. You can calculate the average and send it back, but you couldn't publish it on the front page of the New York Times. So that idea of making it easy to share data whilst being able to control how it's used, we're making that mainstream. We're making it easy to use, and that will be generally available next year.
Fantastic. Richard, thank you so much. It's always a pleasure. I haven't seen you since pre-lockdown, so it's nice to see your face. And thanks for coming on and giving us an update on what's been happening at R3.
You're welcome. Thanks so much for having me. Thank you.
The success of Ethereum has proven the demand for smart contracts, but they haven't come without risk, as many high-profile hacks have already shown. The emergence of a smart contract insurance market is helping to address these issues. Alex Batlin spoke to Hugh Karp from Nexus Mutual and Dan Roberts from Nayms to find out how their platforms are performing.
Thank you so much, Teana, for that. And now next, we are talking to both Hugh Karp and Dan from the wonderful world of insurance and blockchain. Hugh, why don't you give us a quick introduction to yourself before we kick off?
Thanks, Alex. My name's Hugh Karp. I'm the founder of Nexus Mutual, and we are a decentralized alternative to insurance. And our goal is to really be a blockchain-based Lloyd's of London. Anyone should be able to bring any risk to us, and we should be able to cover it. That's our goal in the future, starting with crypto risks for now.
Awesome. And Dan, over to you, sir. Love to get an intro from you.
Sure, yeah. Thanks for having us. Name's Dan Roberts, CEO of Nayms. We're looking to on a similar ilk to Hugh, use smart contracts as a means of providing the rules for risk placement, but risk trade, reporting, claiming, and settlement. So focusing on the sort of entire life cycle of a contract. We sort of feel native to the crypto space, so like you, focusing on digital assets, and particularly that kind of bridge between capital markets and this sort of new, exciting, emerging risk category.
Awesome, thank you both. And in case you don't know who I am, which is most likely. It's Alex Batlin, founder and CEO of Trustology. We are a custodian wallet provider, mostly focused on B2B clients. So we work with guys like brokers, exchanges, and funds, helping them to manage their assets, their client assets, as well as DeFi transactions. Great. Perhaps if I'll start with Hugh. Can you talk about what you believe the problem statement is, and then kind of what customer segments you're looking to address with the solutions you're kind of providing?
Yeah, thanks, Alex. So I think we're trying to build a generalized platform that can cover any type of risk, but we've specifically focused on smart contracts risk to start with, mainly because we saw things like the DAO hack, the parity multi-sig qualities, and other big events. And we thought if Ethereum and the decentralized ecosystem is going to develop, then it's going to need insurance type solutions to cover that risk. Otherwise, it just won't be adopted. As with any kind of new economy, you kind of need basic financial infrastructure, and insurance is kind of part of that. So that's kind of what we're going for. There's always going to be this question when you code something, and code is supposedly law. Code is never really law, but the code operates as you write it. Then, so is that a bug or is it not a bug? And kind of the way we've kind of described things with smart contract cover with Nexus is, if it was clearly against the intentions of what the developers were writing, then we should pay a claim. And in most circumstances, it's going to be pretty easy to determine that. Like if a whole bunch of money gets drained out of something, because there was a check that was supposed to be there and it didn't work or something like that, then that should result in a claim. But the only real way to kind of assess if that's happened is actually put humans in the process to kind of assess that and have some judgment involved, which is kind of a bit strange in our whole programmatic world of DeFi, but having that approach actually gives us a lot of flexibility. So that's the way kind of Nexus works, with a group of people voting on the claims to determine what's legitimate.
I guess that's the point of the mutual part of Nexus. So you have a bunch of people reviewing failure modes and basically voting for or against that. So what happens, kind of how do you avoid people voting the wrong way, kind of?
Yeah, I mean, it's an obvious question, kind of like the alignment of interest type thing. I guess there's two kind of real key mechanics there. One is you have to stake as part of the claims assessment process. And there has to be a lot of stake, like kind of a minimum of 5 times the amount of cover that's being approved in stake has to be there. So there has to be a large chunk of stake to approve a claim. And the first thing is, if the mutual was to decline all valid claims, then it would have no value. And so the people who are staking essentially would have to stake in NXM tokens, and they would drop in value substantially. So that's kind of like a higher level incentive. And then we have a specific incentive, which is kind of lower level. And that's where it's a bit more centralized right now, but that's where we have a group of people that can only punish the claims assessors if there's clear attacking of the system. And that's kind of a good threat to just prevent things from going awry. And we've done a lot of like simulated based modeling and AI agents kind of bribing each other and stuff like that to try and extract money from the system. And it holds up pretty well. But, nothing's better than a real world case. So we're kind of, experimenting with it still, and looking to harden it over time.
Dan, thank you waiting so patiently. I'd love to take your, what's your angle, who are you selling to, and what's the value proposition?
Sure. So I guess we are probably starting with a more general approach. So the problem we came across right at the beginning of our research was huge amount of emerging risk across all sorts of different categories. Smart contract risk being one of them. And poses a big opportunity for the brokers and for the underwriters, more in the traditional space. And there seemed to be a growing amount of not just the big brokers in the market, sort of Aons and Marshes, but the sort of growing grassroots brokers that were coming out of the woodwork specific to serve this new area of risk. They all had their different take on their different products. how they were both mitigating risk and covering it, and they had their own approach to carriers and syndicates to cover that. But we just, some kind of napkin calculations saw that if you're constantly using traditional capital or sort of dollar-based capital to cover the liabilities, then you're going to hit a scaling issue. So at the lower levels of the market, you probably, you'll be okay. There's capital in the billions that's written for all sorts of different types, mainly cold storage and some sort of quote unquote safer risks. But if the space is really going to grow as we're all expecting, then you need the infrastructure and sort of capital that will scale alongside that growth. So the low end billions will be completely insufficient. There's always going to be this sort of asset liability mismatch of dollars covering big Bitcoin loss or an Ether loss that feeds into pricing problems, caps in dollar values, meaning that capital is technically underexposed or overexposed. So we started more by focusing on what was the needs of the brokers, how could the brokers source efficient capital, and we came to the conclusion really that this kind of insurance problem, it's going to be a collaboration. So we're excited to work with the likes of those on the call, but it'll be a collaboration between the underwriters and brokers and capital markets. We've taken a sort of more regulated approach to that by essentially saying the underwriters and actuaries, etc., in the space that can assess all sorts of different types of risk. Not focusing on one necessarily, and we certainly don't dictate the exact nature of what that risk might be, will really be the gateway to bridging the sort of capital markets and crypto native capital markets to begin with into all sorts of different types of risk.
So it sounds like the kind of so what kind of covers do you focus on? What types of risk are you looking to cover?
So I mean, in terms of roadmap, we've got a cohort 1 that we're running November, December this year, and then a cohort 2 that we're aiming for sort of March, April, before a full license next May. And they're both within sort of a sandbox license. So 6 contracts, I would say 5 of them are in the digital asset space. We're looking at some tech E&O, so tech errors and omissions for that is currently the way that brokers are seeing smart contract cover, and all the way down to the sort of safer cold storage reinsurance for some captives and things like that.
So it sounds like you guys are quite compatible. The problem that you're solving for is really the underlying capital base, because kind of if you're insuring crypto with fiat, the problem is you have an FX risk. By making sure that you effectively write the policy in crypto rather than fiat, you mitigate that risk and you're focusing on the reinsurance. Whilst I guess kind of the problem that is being solved by Nexus Mutual is kind of providing a new type of product, which is kind of smart contract risk, and the two can be combined together. I guess that's pretty exciting stuff. So in terms of part of the beauty of the blockchain is it's a platform, so it allows both people to gain some value by purchasing cover, but it also allows investment opportunities for people to participate. So I'd love to understand a little bit about, in both of your cases, the kind of the supply side and the benefits of people contributing to your protocols, so that people understand both the benefit of buying the product, but also contributing to the pool. So perhaps Hugh, why don't we start with you, sir?
Yeah, so there's basically all members in our mutual share risk together in some way, shape or form. That's the idea. And so we've got, there's a variety of functions that you can perform, and you can perform like one or all of these if you'd like. And so the most obvious one is like you can buy cover and get some protection. Then you can also get involved in staking, which is kind of risk assessment. So you kind of back specific risks or smart contracts that you think are secure, and you earn rewards when someone buys cover on them. And so that's kind of like a specific, you share in the risk of the whole pool bit by the nature of just owning a native token, and then you kind of double down your risk on specific risks that you want to back, so specific smart contracts that you want to back in return for enhanced rewards. And so that's kind of one thing. You can also vote in governance, and you can also vote in claims assessment. And so I guess by nature of those things, you can, there are a whole bunch of things that you can do, and there are ways to, I guess some people might want to do some of those, and other people might not want to do all of them. And so, I guess things like your platform is an example of, being able to, if institutions want to get involved and want to restrict the particular access on different aspects, that could help. So yeah, there's quite a lot of things you can do, and but you can do any and all of them, and there are quite a lot of, I guess, rewards involved. Our main goal is to provide the platform to coordinate everyone, and the incentive mechanism to coordinate everyone, and for outside work from the members to be provided to run the whole system where it needs people. So automate whatever we can, and then incentivize people to provide the work where we can't.
What benefits do you kind of offer to the supply side in your system?
Yeah, so it's along the lines of what I was saying earlier, is really just seeing a regulated underwriter as a gateway to the capital market piece, and the technology really lends itself to just easing that process. So we have two general phases. The first one, as I mentioned, is this kind of collateralized piece, where essentially a capital market provider, institutional investor, is backing a specific type of risk, a kind of one-off cover for a year. It's a custodian, it's X, Y, and Z. The contract is still being created by an underwriter. It's still being sort of fairly priced, fairly priced as the initial placement.
Yep.
Kind of like an IPO. And we've structured it along the lines of an ILS contract. So insurance-linked securities, it's a fully collateralized contract that sits there for a period of a year, say. There's lots of interesting points there, and one of them is just it's predetermined for a set period of time. You get your principal plus your yield at the end of the period. If you can find a buyer within that period, then you can trade in and out of that position. But other than that, you're kind of locked in for that period. And we hope this model will spread into an industry like the ILS space, where that kind of trading in and out of positions is sort of very simple, and it's just a bid offer system that everyone's used to. And then the second phase is sort of very similar on the technical implementation, but there's obviously it's quite different, which is we just call it traditional underwriting. It's just much more traditional format, which is the role of the capital provider is to back underwriters, so primary underwriters or reinsurers. Over time, these guys will have track records on the platform. They obviously have track records off chain already that go back decades. But we see that as again an interesting gateway for capital markets to invest in insurance risk without taking on any of the kind of pricing responsibilities. We're hoping that will be an interesting model for not just the capital providers to get involved in this kind of risk, and obviously there's a variety there. Investing in an underwriter, you're essentially investing in a diversified pool anyway. But also for the underwriters to get more exposure to this without necessarily putting a huge amount of capital forward.
So that's really, so basically what you're saying is you're tokenizing the underwriting, and then potentially, you could put it on Uniswap and trade it.
Potentially, yeah.
Yeah, no, that's pretty cool. That's pretty cool, kind of, which kind of brings back liquidity to kind of a lot of folks that might have felt it was trapped and couldn't get out of it. Cool. Roadmap wise, what are your plans for the next kind of 6 to 12 months, which I know is like infinite amount of time in this space. Maybe I should just narrow it down to three months or something. But anyway, whatever that period is, you're comfortable talking about it. What is your roadmap, and what are the unique institutional challenges, especially that you're looking at? So, Dan, over to you, please. Yep.
Yeah, so we're right on the edge of closing our seed round, so we're a little behind Nexus Mutual in that regard. We sort of set up last March, and we just closed funding to give us 18 months. So we do have plans beyond 18 months, but we're kind of focused on that. Over the next 6 months, it's really getting these first 2 cohorts out. So we set up our 2 cohorts. The first one to be more of a kind of technical challenge, technical test. Our beta's on mainnet now, but we're sort of doing these a few private placements of contracts over cohort 1, 10K in contract limits, so they're very very small, but lots of learning there. Cohort 2 is larger limits, real cover. The outcome of these cohorts is less about technical testing and more about providing a story to the market of how this can scale post post trials. So looking around limits of that sort of 500K, 1 million mark. To kind of provide that story going forward. And then beyond that, so as I mentioned, we've got 2 sandbox licenses, and they convert to a full license next May, all going well. And that so next May for us is really a go time for us to gather information, teach brokers, take them through our contract builder, get them comfortable with placing more and more risk towards our Series A.
Great. And I guess the interesting thing is a lot of people don't consider it, and then when they do, they can't talk to us, is to do all that smart contract operations on blockchain, you need private keys, you need to be able to sign transactions, and you could lose those keys. So really important that people plan through, whether it's Trustology or somebody else, how do you manage your keys? How do you manage transactions? So obviously people who are watching and wondering how that plays out in practice, we have really good integrations with DeFi protocols like both of yours that we can help with. Dan, over to you. Plans. Love to hear what you're thinking going forward. Sorry. Apologies.
All good. So I think a couple of things. We're kind of we've got a lot of complicated mechanics in our model about basically getting the incentive structures right, and so we're definitely iterating on some of those things a little bit more. We're looking to revamp some of our staking to kind of make it a bit more fluid and crypto native, and remove lockup periods, and basically off feedback that a whole bunch of people have told us, which is pretty strong. On the product side, we're looking to provide a more comprehensive, wider product that covers a whole bunch of risks much more easily, especially with like DeFi Legos building on top of each other. People don't quite know which systems they're exposed to, so we kind of want them to get a comprehensive cover that covers everything underneath, and so that in one go. And so we're going to be building a product on that side as well. But I think more generally, and this probably applies to this applies to us, and I think where we're going is like the institutional side of things sees insurance as one of the tick boxes before they start getting involved, and so being able to provide in solutions for that type of market is kind of where we're going. And I think most of the people, most of the cover that we've written so far is primarily from those types of individuals. It's been larger cover amounts written by hedge funds or smaller institutions, and we kind of see that's where the main bigger market is for us, while also providing really slick solutions for kind of the retail-ish DeFi crowd.
At which point we will conclude, and I'll hand over back to Teana. Thank you so much for listening, and thank you for participating on the panel, Dan and Hugh. Thanks. Bye-bye.
You've been watching Coinscrum Markets. Thanks for joining us. See you next week.